I'm Karen Jones and I will be your host today, and Ed Prendergast will be presenting. Ed needs no introduction as he and Steve Black have been managing their fund together since November 2004, and prior to that, their industry experience goes back more than a decade. The Emerging Companies Fund has delivered 11.8% per annum to March 31, 2023, and is available and open on all platforms. It holds a highly recommended rating from Lonsec, a recommended rating from Zenith, and a gold rating from Morningstar. Morningstar describes the fund as one for the long term. Ed's presentation will run for about 25 minutes. At the end, there will be time for a Q&A session. So please log these via the Q&A box on the Zoom toolbar. With that, I will hand over to Ed. Thanks, Ed.
Thank you, Karen, and thank you everyone for logging in this morning. Much appreciated. Always appreciate your interest. We will we'll skip through a few slides as a little bit of background, and then we'll talk about our views on the markets, the economy, and more importantly, how that affects the way we're investing at the moment, and also we'll give you a few stock sort of examples to sort of bring it home as to how we're putting in our thoughts into practice. If I could just sort of touch briefly, the slide there you're seeing is a reminder of who we are and what we do and how we do it. And as Kaz mentioned, Steve and I have been running this fund for this is our 19th year, and nothing has changed in the way we run the fund, nor the people who do it. So it's Steve and I run it on our own. We don't have staff within the business or analysts or use external advisors. We do all the investing ourselves. And our sort of our primary process and motivations has certainly not changed at all since the day we opened. The market's changed every day in the economy, and we've been through plenty of highs and lows in a macro sense, but our approach hasn't and won't change. We see small cap investing as particularly there are very strong opportunities to find stocks that and follow stocks closely that not many other people do, because most of the attention is spent on the top 100. At the stock level, there's not much individual attention paid to these companies that we invest in. That doesn't say they're lower quality. It's just that there's not enough money in it for the larger broking houses and the like, which means that the share prices tend. It's certainly easier for us to find things that other people haven't identified compared to those looking in a much more crowded field in the top 100. Having said that, we're certainly not looking for exotic investments. The investments we make are very, for us, very quantifiable, and we weed out the riskier, more speculative end of the small companies market with great discipline. And the way we do that is we won't invest in things we don't understand, or where our understanding of the business is not the key driver of the share price. And if I give you a few examples, we don't invest in mining stocks because we think that it doesn't matter how good the CEO is of a gold company. Ultimately, it's the direction of the gold price, which is the sole determinant of the share price moves over a long period of time. We don't invest in biotechs and loss makers, and there's plenty of excitement in our sector, and excitement is often an illusion. It's where you're straying into speculation, not investing. So we won't invest in things that where there's no recurring revenue or profitability, irrespective of how exciting the technology may sound before it's proven. Equally, we don't we control the risk around liquidity by making sure that where we're investing in very small companies, and we can and do, we invest a smaller amount in those stocks, and the overall and we also will not invest in things where we can't value them properly. So we do discounted cash flow valuations. We know that valuations we've got to be honest and frank with ourselves and you. Valuations are a good tool to conceptualize what stocks might be worth, but they're not the be all and end all. It's not a black box valuation methodology. It's just a good framework for identifying things that we think over a long period of time can be worth 30 to 50%, and hopefully much more over a long period of time. We're big investors in the fund, and we're co-owners of the business. So everything we say is the way we approach our personal investments, and with that conservative overlay. And we're looking for stocks that we can buy and hold for a long period of time, that can grow in a predictable fashion and that are well managed. we won't invest in anything unless we've met the CEO, and often a number of times, and CFO and other people within the business. Small companies is very much an entrepreneurial field where the people that are behind the businesses are really, unless you know them, you've got no real insights as to the risks and or growth opportunities. It's very much a people-driven field of the market. So if we go to the next slide, and the last 6 months has been we're up about 10%, which is 2% above the market. So that's a 6-month period. We do these presentations every 6 months, so it's a bit of an arbitrary time frame. I'd probably prefer to go to the next one. We can come back to questions on individual stocks, but I prefer to go to the next slide just to talk about the longer term track record. Which, given that we are long-term investors, we certainly don't invest on a 6-month basis. We invest on, as I mentioned, 2 to 3 years, and there's plenty of stocks that we've held for 15 years, for example. If I can just summarise, since inception, we've been our net performance after all fees is just shy of 12% per annum, which is 7% above the benchmark. So putting it in other words, if you had invested in just the share market or the small companies index, so to speak, at the start, you'd now, that 100,000 would be worth 230,000, but our fund is worth nearly 800,000, and that's the joy of compounding when you compound that incremental return over a long period of time. So I should also mention that by way of what we do, our turnover is quite low compared to a lot of funds. So we hold stocks on average for 2.5 years. Equally, we're not particularly fussed with short-term volatility in share prices. You can be very, very busy watching each share price move all day, every day, and it's needless distraction in our view. We don't run our business. Pengana does. They half own it and they do all the administrative stuff. So most of our time is spent meeting companies. We see 7 a week, which is more than 1 a day, and that's, our whole game is we've just got to be out there turning over rocks, meeting people, talking to people, identifying where the opportunities lie. And frankly, we waste a lot of time speaking to companies that we won't invest in, but you never know until you've met them. Often the best are the ones that you only realize they're good once you've met them. And then I'll talk, so with the more recent performance there, I mean, it's been a pretty fruity 18 months. In that inflation and interest rate rises has thrown a global spanner in the works and created a lot of volatility. We did make changes in our portfolio to protect ourselves from higher inflation and higher interest rates. But equally, in environments like what we've witnessed in the last 12 to 18 months, and when there's a global such global uncertainty, it's quite hard in a shorter term to determine how well you've gone. It's when the dust settles that you find out what the impact has been. So we would rather have performed better than that falling market. We have definitely protected some of the downside, but time will tell over the next longer period of time. We'll come back to that in a couple of slides. So if we just go to the next slide, thank you, Aidan. This is our performance over a long period of time relative to the market. So you can see it's reasonably smooth, but remember, we've had, since we opened in 2004, we've had a GFC, a pandemic, we've had plenty of global uncertainty, and we've been reasonably consistent. You can see the worst period in time. This is a good indication of the way we run the fund. Because we're strict on valuations, we will always look slightly boring and probably underperform when markets are irrationally strong. And that's what happened in 2018 and 2019. It was basically a mini tech boom. And that when I say we look bad, it was just that we weren't rising as much as the market. And that's what you would expect if we had another tech boom like at the end of the 1990s. Our fund would look slow, and it's because we're investing in relatively boring, predictable things that we like to hold on to for a long period of time, but also are very disciplined on valuations. When valuations don't matter, and it's as easy as getting a tip from a taxi driver, then markets like that tend to leave us behind, and we're not afraid of that at all. So if you go to the next slide, thank you. If we talk now about the economy, so one of the other things to know about our approach is that we are fully invested at all times. So by that I mean we don't decide that, oh, the share market's a bit expensive or we're not finding any opportunities, we're going to sit on 30-40% cash. That's an asset allocation decision that's made by people who approach us to invest. We won't make that call. And we all read the paper every day. It's the one question everyone's trying to answer all the time. There's no shortage of people with a view on the overall market, and there's no shortage of people that are consistently wrong, and indeed the consensus is consistently wrong. And there's no better way of describing that than the chart on the right-hand side, and that is the single biggest driver of share markets in the last, well, you could argue the last 30 years, being interest rates falling for so long, but particularly in the last 18 months, has been how quickly and how surprisingly inflation has come back and has driven very, very dramatic moves in the share market. So if we look at the survey, so the yellow line there is what the consensus expectation for inflation has been. And you can see 18 months ago, the consensus of all surveyed economists or forecasters was that inflation would be just above 1%. And that consensus turned out and we all know what happened in the next 12 months, it went to 7 or 8%. Now, if you had said in May 2021, I think inflation is going to 8%, you would have looked like an idiot, but you turned out to be right. Equally, the consensus today is that inflation will come back to 4%. And nothing against the individuals that make up the consensus. It's just that is as useful as the consensus was 18 months ago when the agreed forecast for inflation was just above 1%. We think inflation is, and we don't have forecasts for inflation. The way we deal with this is we think the risk of inflation staying high and/or being volatile and bouncing back is still very high, and that's because there's a great expression about inflation, and that is the genie is out of the bottle. The reason that makes so much sense is that once inflation has started, it doesn't stop immediately. And it's because, and we've only seen the first phase of this, everyone is paying more for their breakfast cereal, for their construction materials, for petrol, for insurance, all sorts of things like that. That's driven inflation. The second phase, if you like, or the risk that it keeps going, is all based on the fact that the wage inflation hasn't started yet. And that's when workers quite rightly say, well, hang on, if it's costing me more to live, I need to be paid more. And that's phase two. And then when, and we've already seen this, the best illustration there is the move for a 7% rise in the minimum wage in Australia, which is unprecedented in the last 40 years. Now that is a justifiable request. And if it goes through, that will drive a response by the, call it retailers or the factory owners or whoever it is that employs those workers at a higher rate. They'll pass it on with higher prices. So even in the US, wage inflation is still below inflation, and same definitely here. That's a concern for us. Higher interest rates only impacts a third of the economy in Australia. It's the people with mortgages. There's plenty of people out here that don't have mortgages, and so you can't control the economy that perfectly by just tweaking interest rates a bit up as they have been, and expecting that to cure inflation immediately. As I said, we don't have a view on inflation other than if the risk of it being high is high, then we certainly make sure we understand what that means to the individual companies we invest in. We also think that the domestic economy, given that we've got all this sort of negative, there's a lot of negativity around, and Aidan, I'll get you to go to the next slide. You can see consumer sentiment is poor. On the slide on the right, it's as bad as it's been for when's that? It's at least 10, 12 years. So we know that there's negativity out there, except the retail activity, people are still spending, and it's because employment's still strong. And as I mentioned, higher interest rates doesn't affect everyone. So the retail environment, we think, is risky, and that is that over the next 6 to 12 months, when people roll off their fixed mortgage rates, and this, and if you get any rise in unemployment, because higher interest rates will at some stage have an impact, whether it's through slower housing activity, slower construction activity, those sorts of things, then we would be very wary of companies that are in the retail sector, particularly discretionary retail. And you saw yesterday, there's already been a downgrade at Star Casino. They've mentioned that the consumer has switched off in the last little while. But keep in mind, when we talk about inflation and overall markets and things like that, we are only interested in how it impacts on individual stocks. So inflation sounds bad, and we think it is, but there's plenty of companies that actually, at the individual level, inflation is actually very good. If I can identify and break it up into two simple groups. So inflation for healthcare providers, or some healthcare providers, is bad. If I give you an example, if you're a pathology a provider of pathology services, the price you charge is regulated by the government. Your costs are your own. If costs are rising, you can't pass that on because the government's is not going to instantly want to raise the price of the service. So therefore your margins shrink. If I give you another example, KLS, which is a stock down the bottom, they're a bus driving operation. So they drive buses with contracts with the government in various parts of the country. Now, we rang them immediately when we thought, oh, inflation could be a bit of a problem. This is 18 months ago. And their contracts are specifically CPI plus. So whatever the wage rate of the driver rises by, they pass it on. So inflation is definitely not bad for them. And we'll come back to it in a bit more detail later, but insurance brokers certainly don't mind inflation because they charge a fee on the rate of insurance they sell to people. So higher, if insurance goes up by 10%, so does their revenue. And there's other groups like LIC, which I mentioned there, that's lifestyle communities. I'll come back to them. Their rental contracts are inflation based, so higher inflation, higher revenue, not a bad thing. There are certain, I won't go through every stock, but there's certainly other stocks that we've been able to, 12 months ago, make sure we sold down based on inflation being a bad thing. Higher interest rates is another aspect. Obviously, we look at the balance sheets and identify those that are exposed to higher interest rates. But equally, higher interest rates have an interesting effect in the share market, in that stocks with higher ratings or valuations, i.e. there's more confidence in their future earnings, those stocks tend to fall further if interest rates go up than stocks with shorter term pricing. And so we made corrective action again 12 to 18 months ago to make sure that if the risk of higher rates comes to fruition, we're not exposed. And if I can explain that in simple terms, that's why NASDAQ fell by more than the overall market in the US last year. It's because they are those sorts of stocks. It's tech stocks and the like, which are higher growth but high valuation. And then I make a point in the slide before, which is probably worth mentioning, that the banking situation in the US is beyond our understanding. We have no firm view on whether or not there are going to be further bankruptcies in banks. I think the risk is definitely elevated, but I'd also say that if we don't have a view, it's not because it's not because we don't understand the banking system. Not even the Fed Reserve understands the risks within some of these individual banks in the US, and that's made clear by the fact that Silicon Valley and Signature Bank were both perfectly healthy one week and dead the next. And it's an unfortunate reminder of how fragile some of these banks are. Now, whether or not that results in further bankruptcies at the banking end in market in the US and what spillover that has into markets and the like, we don't know. But certainly in instances like this, it's good to be reminded that there are no experts on the likelihood of further problems. We'll just wait and see. There's certainly reason to believe that if there's not any more bankruptcies, at least one impact could be a tightening credit environment where banks individually just say, well, we'll just in case, let's lend less. And less lending is the equivalent of quantitative tightening, which is certainly not good for economic activity. So if we go to the next slide, Aidan, for all the discussion we've just had, which is about what do we think, where do we think the risks are to the economy, our portfolio. So since we started, Steve and I have always focused on companies that don't require the economy to be growing particularly strongly to grow themselves, and indeed can withstand a complete recession. And there are good examples of this. Industries like the funeral industry, it doesn't matter what happens in the economy, there's not going to be an impact on their volumes. The insurance broking industry is very resilient. Telcos are very resilient. healthcare, but healthcare's got problems with inflation. So for another reason, we're not invested there at the moment. But if we just talk about the chart on the right-hand side shows you how our portfolio is currently constructed based on the sort of the revenue characteristics of the business, and defensive growth is capturing those businesses like funerals and insurance broking and the like, and we'll go and investment platforms are reasonably defensive. Also businesses which have pricing power, which is a separate issue, but it's certainly important to us at the moment. So you can see there's cyclicals, and that's we do own a few stocks in the travel industry and non-residential construction, so they are cyclical, and financials have also got cyclicality. It's quite a small part of our portfolio. Ideally, I'd love to say that 100% of our portfolio is invested in companies that don't require the economy to grow, but we do find opportunities where the market, as we see it, is incorrectly pricing whatever cycle the company is in, and there's cyclicals ain't cyclicals. They're all different. They all run on different cycles. You could have a shocking, if we're right, the retail environment will have a dreadful 12 to 18 months, but non-residential construction will be very, very strong. So there's two cycles at opposite forces there. The reason being that the state governments and federal governments have put in so much money in their budgets for, road repairs, rail, those sorts of things, and that's what will be, in our view, what will be quite strong. So a company like Seven Group, which owns Coates Hire, will see a lot of rental activity for their gear, which is, and that will happen even if discretionary spending at the retail environment is a disaster. So that's probably, and then technology stocks. There's 5 or 6 stocks in there that are all profitable, predictable, growing, and certainly on our numbers worth a lot more over a long period of time. So Aidan, I'll get you to shift forward one more. So when we talk about volatility, I think what we saw in the last 12 months, we're still in the middle of. I don't know when it ends, and I can firmly say I'm not. So as I mentioned before, there's 1,000 views on when this will end, or how bad it'll be, or how much it's already factored in. We're not going to make a bold call on that. But one bold call we will make, and we can definitely back this up with the chart on the right, is that what typically happens during periods. So the investment time horizon of most investors globally. If you speak to people that sort of, oh yeah, we're long-term investors, and that's fine. When you get a GFC or a COVID or an inflation spike, the investment time horizon goes from years to weeks and potentially days, because people get distracted. Investors globally get distracted by large unpredictable events that create volatility. And so at the moment, is it the inflation on, inflation off, interest rates up, interest rates down, banks going broke? That brings everyone's attention span to become very, very short, distracted, irrational, chaotic. Now, those sorts of environments, they're difficult for anyone to negotiate their way through, because you never know how bad it's going to be nor how long it goes for, and no one will ring you at the time that it's finished. You find out later because markets run ahead of time. But what they typically do is create opportunities for us, because we only live in the individual stock world. We look at individual share prices and say, is that business worth a lot more? And often, because of how distracted the global investment markets are, people sell the wrong things irrationally at the wrong prices. That can be great for us. So I'm going to pull out 2 examples there. You look at so the chart on the right shows you our performance compared to the market each year since we started. So you can see we beat the market most years. In 2018, you can see that was our bad year. When I say bad, we were 4% below, but that was because the market was irrationally strong. But if I pull out 2009 and 10, and then 2021, the first 09 and 10 is the 2 years after the GFC. So you can see that the GFC threw us around. We fell with the market, disaster. No one knew what was going on. But when the market returned to rationality, calmness, the attention span went from days to weeks to months to years again. We outperformed the market in a cumulative sense by well over 45% in 2 years. So whatever it rose, we rose by 45% more. And then if we look at the calendar year 21, that's the period after COVID. So you can see COVID in 20, we were swirling around with markets, and it was a pretty weird time. and we were, at no point were we confident that I'd love to give you the sense that we're confident all the time. We're nervous all the time, and we should be. But equally, when the market returned, we were holding stocks at that time thinking, I cannot believe people are prepared to sell that individual company at that price. We will take it on and buy it, and hopefully over a period of 3 to 5 years, it'll return to value. We didn't have to wait 3 to 5 years. Calendar year 21, our performance was more than 20% above the market, and that's because a lot of stocks, they're boring companies, they're not exotic. A lot of companies bounced very, very hard and returned to what we describe as normal value, and came together well for us. So just to go back to where we're, I guess, to swirl the full circle, we don't know how inflation ends. We don't know what happens with the banking system. We don't know where interest rates will peak, and nor do we know whether or not there's a hard landing or a soft landing. Those are all imponderables. They're big risks. We manage them around the individual stock level, but equally we know when the market settles down, those times are often the best for a fund like ours, or certainly we've had the history there. So if we look at the next slide, please. I might actually I'll come back to that, Aidan. I'll go to the one after, if that's all right. What I'll do now is just give you 4 stock examples to describe things that we own currently and why we bought them and why we hold them, with relevances to the environment. So IVE Group it's not really the sort of, I mentioned before, our favourite stock is something we find that can grow predictably for 5 to 10 years. And we've got plenty of them, and have had plenty of them. IVE Group is different in that we believe this stock is just fundamentally wrongly priced. And to describe it briefly, they're the largest Australian, they design, print and distribute brochures. So it's retail brochures. So I'm looking at the sticker at my front gate. I've got a no junk mail sticker, so I'm not a customer of theirs or a recipient of their product. It's a business that we've watched for years. It doesn't grow by that much. It is very well run, but it doesn't grow. And that's because it's relatively mature. And equally, the internet is slowly, or has definitely made an impact on brochures. People are shopping in different ways. Now, we've watched this for years thinking, well, this business will just disappear. It'll be like Cobb & Co. It'll be fully replaced, or newspapers. But they're still delivering to 7 million households in Australia each week, and it has leveled out. Brochures are actually valued by retailers, and it's people like Bunnings and Woolworths and Aldi, IGA. They do work, and it's because you can put specific products in your brochure and watch the sales rise. So they're still definitely a large part of the market that enjoys brochures. When we looked at it after COVID, you can see the share price was pretty volatile. We went back to it and we thought, well, hang on. If that's the case, and it was trading on a fully franked yield of 10%, a PE of 7, and no debt, and we looked at it and we thought, well, it doesn't matter whether or not it doesn't grow. This stock is worth 50% more on our numbers. So we bought it after doing a lot of work. We did tours with them, and anyway, it's now trading at 50% above where we bought it, so it's done quite well. We think it's now worth more based on the fact that in the meantime, they've bought out their only competitor, a group called Avato, which went broke. And there's an enormous boost to earnings. And if you just go to the next slide, on the right-hand side, you can see the profit growth has been mild and a little bit blurred by COVID, but you can see in 23, we expect quite a large boost in profits, and that's the acquisition of their largest competitor coming through. They basically paid for the contracts that their bankrupt competitor has, and they'll put it on their own printing machines and through their own operating model. And there's very strong operating leverage to be enjoyed. And you can see on the left-hand side, that's their operating margins. It's not that volatile a business for all of the disruption of COVID. The margins didn't really change much. So, but long term, if it gets to our share price target, I don't think we're going to hold this for 10 years because beyond what we've described, there's not a lot of growth left. If you go to the next slide. Propel Funerals is definitely something that we think we can hold for a long period of time, because we can see the potential for it to grow predictably for 10 plus years. It's the second largest operator of funeral homes and crematoria in Australia. The largest is Invacare, which is another listed company which was very successful in buying other businesses and growing scale through acquisition. It got to the point where the ACCC has restricted its ability to grow. Propel Funerals is the founders own nearly 20% of the company. They have long track record in the industry. You can imagine the name says it all. This is not a business where volume changes, particularly where we don't have to, predict the economy. The volume is there, and the changes in volume for the funeral industry largely go around disease and weather and flu seasons and the like. But that's long term. That all smooths itself out. If we just go to the next slide, Aidan. The real appeal in Propel Funerals, firstly, on the left, that the rate of growth in deaths in Australia is increasing. We're just entering that light blue period now where the baby boomers are moving into the customer base, so to speak. And so the rate of growth, that's one positive for them. But the real picture here is that on the right-hand side, these are the two charts show the industry structure 7 years ago and 1 year ago, and that is that Invacare, so it hasn't really grown. You can see there they've set it there in their market share at 20-25%. Propel Funerals has grown 6 times or sixfold, from 1.5 or odd to 7% market share. Most of the operators in funeral homes are family businesses. There's a multitude of them. There's a reason for, and they're available for sale. It's what Invacare did, and it's what Propel is doing. We'd like to think over a 10-year period, Propel might be able to get to Invacare's size and therefore grow it, be 3 times the size as it is today. And they buy businesses on very favourable valuations. So that, if that plays out, as I said, ideally we're holders of this for a long time, and the valuation stacks up. If you just go back a step, Aidan, see the share price. This is the best example I can find at the individual stock level of how irrational markets create opportunities for us at the share price level individually. Propel Funerals share price fell by 35% in 2 weeks at the start of COVID. That to us was dumb. The business was not worth 35% less. You can buy it for 35% less, but just because there was a short-term restriction of attendances at funerals, and the revenue was hit, but that was never going to last. We knew that. So we bought a hell of a lot more stock then. And again, when people go from investment time horizons of weeks, that's good news for us, because when they go back to years, the stocks like this tend to correct in value, and you can see it doubled in share price from that COVID distraction. So Hayden, Aidan, if you hit, here we go. Thank you. Lifestyle Communities is another stock that we have held for almost a decade, and we want to hold for a long period of time, as long as it stacks up and as long as the valuation is intact. These guys build and rent out retirement villages for the lower end of the socio-economic scale. For those in Victoria, just think it's places like Tarneet and Cranbourne and Lara. The property prices there are the very, very low end of the market. It's not a particularly competitive field because not many property developers see profits in this sector. Lifestyle Communities model is very specifically around providing cheap accommodation, cheap/affordable. It depends on the word you want to use. But when they sell a retirement village unit to someone who moves in, it's about $350,000. The person that moves in doesn't buy the land, they rent it. And that rent roll is the reason we own Lifestyle Communities. So they started with one village when we first looked at them, and they're up to about 15 villages now. Every one is the same as the last one, and there's an enormous growth opportunity. They could get to 40 or 50 easily over a long period of time. And so it's very repeatable. It's very easily understood from our point of view. It's not cyclical, and the market for property at the low end is nowhere near as volatile as harbourfront property. So a property boom and bust is not really the driver here, and it's very capital efficient in that once they've sold out a village, that capital is then redeployed to buy more land, and they've got a never-ending kind of growth trajectory coming through. So if you go to the next slide, this is. If I could describe in a picture, if we could describe the perfect stock, this is absolutely it. So this is the rental revenue they receive each year, and it's recurring. It's linked to CPI. So there's inflation is good for them, not bad for them. And as they fill up each village, they move on to the next one and the next one. And unless people leave the village and it's not replaced, that graph should never fall. It should only rise over a long, long period of time. And that's why this picture is exactly why the share price has risen from $2 to $22 over the period we've held it. And we think, if I'm doing this presentation in 10 years' time, I hope to have that exact same chart with the exact same shape for another 10 years out to 2032. Go back a step, and one thing that we won't do is just hold a stock at any price, though. We think this is particularly well managed. The CEO and founder is still very actively involved and a large shareholder. But you can see where the stock price went bananas there in 2021. It rose from $15 to $24. It actually went above our valuation. We sold 2/3 of our holding. It's not because we don't like the business. It's just that at that price, it was just too good. And then when it came back, we've re-entered about half of what we sold. It corrected pretty quickly. That sort of volatility is sometimes an opportunity for us, and in that case, very much an opportunity. And that was a big driver of our performance in calendar year 21 as a fund, because it was our biggest holding. And then one last, we're wrapping up 3 stocks here because they're very similar. They're the insurance brokers, AUB, PSC, and Steadfast. They do look and feel and are very similar in that their core operations are the same, with just a sort of slightly different factors. So insurance broking, again, going back to industries that we love, this has attributes. This has some of the best attributes we can find. And that is that it's very stable. The demand for insurance, so these guys sell insurance to small businesses. The demand is very stable. If you think about it, you'll never hear the CEO of a small company say, we're going to try and save money by just sort of going without insurance for a year. They'll cut Tim Tams out of the tea room without a thought, but there's no way they would stop insuring. Then the brokers themselves have very, very strong relationships. It's a weird purchase. Most brokers retain their customers. They retain 95% of their customers each year, so that these 3 don't really even compete with each other. And if I can invert that and express that in another way, if you're retaining 95% of your customers, each customer on average is staying 19 to 20 years. Now, that's a good business. If I had customers that stay that long, and hopefully they do, that's a really good business. Because it increases your ability to forecast out a very long period of time and not worry about the economy. You can see that we don't have the cash flows there, but the GFC and COVID had no impact on their earnings, or very, very minimal impact on their earnings. And then the rate the one last, so the industry's been consolidating. They've been buying private companies and putting them in like PROPEL does. That's coming to an end. So the growth angle through acquisition is getting slightly harder. But if we just go to the next slide, this next slide describes to you one last factor that we like about the insurance brokers, which may not last forever, frankly. We need to watch this, but that is that the price of insurance has been rising consistently. So if they're arranging insurance for people, they're doing it they take a clip of the cost of that insurance, and so higher insurance prices is good for their profits. Insurance prices have been rising at 5 or 6%. We're hearing now they're likely to rise by 10 to 15, maybe even 20%, depending on the line of insurance. And some of it is inflation, some of it is disasters at the environmental level, some of it is volatile markets. So insurance companies need to make money through the rate of the insurance rather than their investment income. But equally, this is a great chart to illustrate really simply firstly, why insurance rates are likely to rise for your household insurance, but equally another great example of why the first round of inflation is never the last. So CPI, so there's 3 lines. The dark one is CPI, that's obvious. The second line, the yellow line is the house construction inputs. Now, put simply, that's the cost of rebuilding your house if it burns down in a fire or if it is flood damaged. So the cost, so this is tradies, timber, brickies, those sorts of things. It's gone absolutely bananas in the last 2 years, and anyone who's tried to do a renovation, this is exactly why construction companies are going broke. It's because just how quickly the cost of construction has risen. It's up by about 20 to 25% over that period in a total sense. Now, if I can express that back to you, and I had to think about this, I only saw this chart 3 weeks ago. The grey line is the rate of insurance that we are all paying for the replacement of our houses. So the BSI change, which is the business sum insured, building sum insured, sorry. Effectively, so what's happened is let's say I'm paying insurance based on the replacement cost of my house being $500,000. It's not $500,000 at all now. It's probably more like $650,000 to $700,000. And I haven't realised that, so I haven't paid more insurance. Insurance brokers are legally obliged to advise strata groups and the like that this environment has changed, and they're taking a risk that if the fire comes, they're not going to get the full payout unless they increase their insurance. So that grey line will increase. That means insurance rates will rise more, and it's just an unfortunate lag, and most households haven't realised this yet. It's another dip in the pocket. But certainly good for the insurance broking sector. So why don't we leave it there? I'm happy to pull out any stocks that anyone would like to discuss. Just while we've got the Charter Hall is no longer in our top 20, we think that the environment around property investing has changed dramatically. This was as at the end of March. With the bank situation in the US, commercial real estate heavily reliant on regionals in the US, we think that the risk of problems in commercial real estate is high enough for us to remove Charter Hall from our top 10 because they are definitely a fund manager in that sector. While we think there's value in the share price now, we can't account for the scale of any risk if it goes wrong. So, but otherwise, everything else is intact, and I'm happy to answer any questions.
Excellent. Thank you, Ed, as comprehensive as usual. And you have already actually covered off some of the questions that have come through, but there's a couple that have also come through that we might go a little bit deeper into. So the first one is, Ed, can you speak to ACL? Are you still invested in the business? Your thoughts re the proposed Helios takeover. You mentioned caution in regards to healthcare and inflationary pressure. What are your thoughts on ACL and the sector as a whole?
Yep. So we sold most of our we sold our Helios 6 to 12 months ago on the basis of they're exposed to inflation. ACL we sold some, but in hindsight not enough. But then it got to the point where it was kind of ridiculously cheap. Even when we threw all the inflationary assumptions at it, that at a stock level, the share price was actually telling you that in our view, that it was that it had been oversold. So we have about 1% of the fund in ACL, that's probably worth you just knowing that that's a very small position for us. It's not a large investment. It's based purely on the fact that we think it actually, it's not worth zero, even if inflation comes through. It's definitely worth, in our view, more than the share price. And then as it relates to the merger, I'm not sure it'll happen because they haven't really offered a premium. It could happen. It definitely makes sense to put businesses like that together because you've got distributed operations and a head office cost, and you can remove a lot of those head office costs if you combine the distributed operations of both businesses. So, but we're predicting the outcome of takeovers is it's kind of we would never invest according to that, because if we're wrong and let's say we thought it was going to definitely happen and that's what we needed to justify our share price, and for some reason it's pulled, then you just end up losing money on something you can't control. So we'll wait and see.
And the next question is to do with one of the current holdings that you did cover off quite extensively today in Propel Funerals. The question has come through, is Propel Funerals over-earning?
Yeah, yep, absolutely. And that was, so we had a little bullet point on that in the slide. No, absolutely. So the death rate in Australia last year rose by 17% from the base. So like it or not, we lost a hell of a lot of people last year. COVID was partly to blame. There's all sorts of other disruptions to our health which have come through, and I'll leave that to the experts to ponder. So the rate of growth in Australia in deaths has never exceeded 7%, and it was 17 last year. So that's pushed volumes well above a long-term trend. So the way we value the stock is to remove that, and the same way we would value a fund manager. If they had a performance fee 1 year because of good performance, we would remove that from the next year's forecast and say, what's the stock worth, assuming that doesn't happen again. And that's what we've done with our, so it's definitely over earning, but we don't think that the price, therefore, is that the share price has captured that and capitalized it forever.
Excellent, thank you. Another question's come through that you're obviously talking to a lot of companies, as you said, 7 companies a week on average. Without naming names, are there any obvious nerves out there? And if so, are they in a particular sector?
So this is I'll take it that the question is relating to our nerves about the investments that we've made, not the nerves of the CEOs.
Or the CEO's nerves about their industry with the interest rate pressures, inflation, cost of living.
There are, but typically, this is going to sound harsh. Most CEOs are optimists, and it's very hard. So let's say if I give you an example, we think that right now, retail over the next 12 months is not going to be as good. So in 12 months won't be as good as it is now. If you talk to the CEOs in the retail industry, they're hardwired to never believe the sales are going to fall. It's not how they run their businesses. And same with housing construction, same with mining, people that are exposed to the cycle. So we we don't treat them as great predictors of the future. So if we ask, because quite often they're optimistic until the day before it goes to the custard, and then they go, "Oh, we were wrong." So so there's plenty of optimistic CEOs out there. The CEO of ABC Learning was very, very optimistic leading right up until the day it died. So not to be personal there, but we don't take their optimism as any guide as to the way we think about the risks of them being wrong. But then as it relates to our nerves, we've identified areas of the economy specifically that we think are bound with risk. So we're not nervous, we just don't invest in those stocks. We've identified it as an area that we would avoid. But ultimately, I don't want to leave anyone with the impression we're 100% comfortable in everything we invest all the time, because we're not. We take risks, and we get hopefully if we get 6 or 7 right out of 10, then we give the performance that we have, which has been good. But we've been nervous about everything all along. There's always uncertainty everywhere. It's for us to negotiate it.
Excellent, thank you. Well, in the interest of time, there are 2 or 3 more questions, but we'll get that back to those people on an individual basis, Ed. We'll follow up with them. It's terrific that everyone's been able to dedicate just over 45 minutes to the session this morning, so we'll let people get back to their normal days. But I guess what I take out of it, and also from working with Ed and Steve over a period of time now, that, I'm sure a lot of people have been listening to Ed and Steve for 18 years now, and there's a great deal of comfort that the guys just don't do anything differently. There are no surprises. They'll always just invest in companies that are quality companies and providing value for their investors. So I guess, Ed, keep on keeping on, and thank you for your time this morning as well. There are 2 more webinars coming up in our series in the middle of May for our Australian Equities Fund and also for our Private Equity Fund. So if you'd like to go to the website and register for those 2 webinars, please do so, and we look forward to seeing you at those. Again, thanks for your time and have a terrific day.